Good afternoon, ladies and gentlemen. This is Jesse Colombo doing my second Forex webinar. I'm excited as usual. Hope you are too. We're going to learn a lot today about Forex and global economic trends, and I want to make this presentation relevant to not just Forex traders, but people who invest or people who are just concerned citizens who want to learn more about economics and some of the work that I do. So I'm going to try to integrate all those different topics together, and hopefully we'll all learn something from here. So today's presentation is called Introduction to Forex and Forecasting Forex Trends. It's a bit different than the presentation that I gave last Friday, and I want to make a point to switch up these webinars so that you guys stay interested, and myself as well. I don't want to keep doing the same thing over and over. And today I'm going to be discussing the basic concepts of Forex, and then also obviously how to forecast them. And then we're going to have a Q&A session at the end where you can ask me questions about obviously Forex or global economic trends, forecasting, or even other topics such as economic bubbles, how to prepare for them. So it's definitely an open format, which I like. Just think of it as we're all sitting around Friday afternoon, a bunch of friends having a beer. So here we are. Just going to introduce myself. I'm Jesse Colombo. I'm an economic analyst and researcher, and I became known for predicting the financial crisis when I was a fairly young fellow, when I was about 22 years old. Believe it or not, I started warning about it when I was 18 years old in early 2004. And I had been studying economics, and I had taught myself, and had been trading for a few years at that point and doing my own research, and I discovered that there was a major bubble. Housing prices were soaring, and people were borrowing, and from everything that I had researched, that was a classic bubble. So I built a website called stockmarketcrash.net, and this website became quite well known, and it was one of the foremost highly trafficked housing bubble related websites according to the LA Times in 2005. So I was a college student when I was doing this. And then when it all collapsed in 2008, I was recognized by the London Times for predicting it. And I became known for that, and then also because I've been warning about subsequent bubbles that I've been noticing developing around the world after the global financial crisis. So here I am doing the same thing I was doing 10, 11 years ago because the world hasn't learned. And this ties in very heavily into Forex and trading and international economic trends. I'm going to discuss how they all relate in this presentation. I'm also a columnist for Forbes.com, write a pretty popular column about bubbles and trading and other topics in economics and finance, and I produce these big reports about bubbles that are developing around the world, and they make news headlines, and they get all sorts of government leaders and central banks mad at me, including prime ministers. So very interesting. And then I'm a social media personality. I'm quite active on all major forms of social media: Twitter, Facebook, Google+, Scutify, you name it, I'm probably on it. And if you want to follow me, just search in Google Jesse Colombo. You can follow on any of those social networks that you want. I have around 100,000 followers on there, so quite a few people are interested in these topics that I'm discussing and warning about, so as well as the trading implications. And most recently, I partnered with Cyber Trading University to teach these Forex and futures and swing trading and other types of webinars. So I've been really enjoying it so far, and we have lots of other interesting topics to go over with webinars in the future. So I want to start just by discussing and teaching you what Forex is. Not many people have heard the term Forex, but everyone knows what a currency is. And Forex is just a term that's used to describe the international interbank currency market. and the trading of these currencies, particularly speculative trading, where people try to profit from these moves in these currencies. They all trade against each other and they move up and down just like stocks and bonds do and real estate prices. And there are many people out there who basically have mastered the Forex market, and that's what their focus is trading currencies. And what's interesting about Forex is, unlike the stock market or the futures market, there's no single exchange. It's not like there's a New York Stock Exchange or American Stock Exchange for Forex. It's completely decentralized, and it's called the interbank market. And it's a type of what's known as an over-the-counter market. And it consists of banks and other major financial institutions that deal with each other directly via electronic communications networks. So you'll have Deutsche Bank trading with JP Morgan, who trades with Goldman, and so on and so forth. And there are other market participants as well, retail Forex traders, which many of you are. And we'll discuss those different participants shortly. And even though the average person off the street has never even heard the term Forex, it's ironic because this is actually the most active financial market, with over $5 trillion worth traded every day. Not in a year, every day. So it's just massive. And that's why, even if you don't trade Forex or intend on trading Forex and you just trade stocks, I firmly believe you should be aware of the Forex market, because everything is interconnected and it does affect your stock investments. Even if you're not a stock trader, but you're just an investor, you have a 401k, I believe it's very helpful to know and understand these international currency trends. And the fact that this market is so actively traded is one of the reasons why it's extremely beneficial for traders, because there's so much money being traded. And I'll explain those benefits in the next few slides. But first, I want to discuss who trades Forex. And first and foremost, most likely trading the largest amount of volume in this $5+ trillion per day market are investment and commercial banks. And as I said, it's an interbank market, so it goes to follow that it's banks that are dominating much of the volume in this market. Also insurance funds and other large financial institutions. Everything from JP Morgan, an investment bank, to a company that's a commercial bank like Sumitomo Mitsui Banking Corp in Japan. And they're constantly in the market. They're hedging for their clients who have exposure to currencies and want to protect themselves against adverse movements. Or you have some of these banks are speculating in the currency market, trying to profit from the moves. Another major participant in the Forex market are central banks, particularly when they intervene in their currencies. Many central banks actively try to manage their currency and its strength or weakness against other currencies. And two notable examples of this are Bank of Japan and Bank of Israel. And very frequently, these central banks that are intervening in their currencies are not intervening to make their currencies stronger, as you would expect. You would think a strong currency is a sign of economic strength. But quite the opposite. Most of these central banks are trying to weaken their currencies. And the reason why is because they're trying to make their exports, their country's exports, more competitive. So in the case of Bank of Japan, they want to weaken their currency, which is the yen, because they want to make their exports more competitive around the world. Like you have companies like Toyota and Sony that derive most of their revenues overseas, so it behooves them to have a weaker currency. And especially, particularly, Japan is a very export-oriented economy, so their central bank, Bank of Japan, is trying to weaken the currency, and that tends to be their bias. Same thing with Bank of Israel. They've had a big problem with what's known as hot money, or too much money is just flowing into their economy, and a lot of it has to do with their hot startups, tech startup sector over the past few years, where you have many U.S.-based Silicon Valley corporations are buying Israeli startups, and they're spending billions of dollars to buy these startups. And what do? They convert U.S. dollars into shekels, and that creates an upward bias on the currency, and that hurts Israeli exporters. So Bank of Israel has been trying to weaken their currency. So central banks are a major player, and they basically control the currency, so it's not too surprising. Another major type of player are companies with overseas revenues, like the exporters that I just discussed, or importers, anything that has to do with international trade. Companies like Toyota, General Electric. General Electric is a U.S.-based company, but they receive much of their revenues from selling to Japan, to Europe, to China, all sorts of, China is building massive infrastructure projects, and they use various General Electric products, from generators to MRIs. It's a massive conglomerate, so they have a very large exposure to the Forex market. And depending on the way these currencies move, these exporters can stand to gain or lose just based on these currency fluctuations. And they do their best to try to hedge or insure against adverse movements. So they're not trying to trade the Forex market to make money. They're just trying to focus on their core business, and they don't want to get hurt by a major currency move that devalues their revenues. So we'll discuss that. Another major player are hedge funds. And these are institutions that are exclusively focused on speculating or profiting from currency moves. And they're large players. They move billions of dollars, actually probably trillions of dollars per year. And then next you have retail traders, as many of you are. Someone who trades with FXCM or Interactive Brokers or Owanda are retail traders. They're home traders. They're private investors. And they trade oftentimes from their home. They may be hobbyists, or they may be skilled semi-professionals. Maybe even if you trade from home, and let's say you're a skilled Forex trader and you are making a living doing it, it's still considered to be a retail trader because you're not trading with a hedge fund, or you're not part of a major financial institution. So now I want to discuss the 7 major currency pairs to be aware of. And these are all actually, pardon me, let me go to I'm sorry, I skipped a slide. We'll go to that next. So I want to first discuss the 8 major tradable currencies. These are the most liquid, most actively traded currencies, and this is where 99.9% of retail Forex traders focus their trading on. Number 1 is the U.S. dollar, unsurprising. It's the world's reserve currency, one of the strongest currencies in the world right now over the past 7 months. And the symbol for it, if you're in the world of Forex, is USD. Again, no surprise there. And its nickname is the buck. And what's funny is that many of these currencies have their own nicknames in the trading community or economics community. And some of these are pretty entertaining, and I'll show you. Next, you have the Japanese yen, JPY, the euro, EUR, the British pound, GBP. Its nickname is cable. You can say, sell me 100,000 cable, or buy 100,000 cable. And traders in these trading desks, I believe a lot of these nicknames came from these interbank dealing desks that we were discussing before. So that's where they came up with these nicknames. And then you have Canadian dollar, CAD, the loonie, Australian dollar, AUD, is known as the Aussie, or I believe the Australians say Aussie, but some Americans say Aussie. That's how it looks phonetically. Next is the New Zealand dollar, or NZD, or the Kiwi. And then the Swiss franc, or CHF, the Swissy. And CHF, most people don't understand where that comes from, but it stands for Canton Helvétique. So it has to do with the Swiss provinces. So it's a French word, and that's where the CH comes from, and then the F obviously stands for franc. Oops. Where are we? Okay, here we are, the 7 major currency pairs. So when currencies are traded by cash Forex traders, you don't just trade one single currency itself. These currencies are paired against another currency. So you're buying one currency and you're selling another. And the major pairs they're all major currencies to begin with, but they're paired against the US dollar, which is the world's reserve currency. So the first one, this is the most liquid, most actively traded. This is the euro versus US dollar. And this is commonly quoted as almost as frequently as a major index, like let's say the Dow or the S&P 500 in the stock market. So even people who aren't Forex traders tend to look at the euro versus US dollar. Next is the British pound versus the US dollar. Another important one. It's a major trading partner, a major world leader, obviously. Australian dollar versus the US dollar. And then New Zealand dollar versus the US dollar. Next, US dollar versus the yen, or they call it the dollar yen. That's another major liquid, actively traded pair. Next is the US dollar Swiss franc. Recently had a big move. We can discuss that later on in the Q&A if you'd like. And then the next one is the US dollar versus the Canadian dollar. It's a major, I believe Canada is the destination for 20% of US exports. They're one of our largest trading partners. I believe it's our largest export partner. They're just north of us, obviously, and you have large numbers of goods, massive amounts of goods and services that are just going right across the border, and they're shipping us their oil, and we're shipping machine goods and all sorts of services. That's an important one to watch, even if you don't trade Forex, just as an indicator, just to be aware of. So now I'm going to discuss the factors that move currencies, and there are just so many factors. It's like to analyze the market as a whole is like playing three-dimensional chess, as they did on Star Wars. That's a metaphor I like to use sometimes for the financial markets, but that's what makes it exciting, is because it's this puzzle that you're constantly trying to figure out. There's so many different pieces to it, and it really does help to focus on one small aspect at a time rather than biting off more than you can chew and getting overwhelmed. So number one, and not necessarily in any particular order, but this is one of the fundamental reasons why currencies move, is international trade. So if there's a large amount of demand for yen, for example, because all people around the world or companies around the world have demand for Japanese products, it tends to put pressure on the yen and push it upward, and so on and so forth around the world. So international trade, obviously, massive dollar amounts moving all day long throughout the year. Another one that fewer people are aware of are interest rates and interest rate differentials. And each currency and each country and economy has its own interest rates. You know, you hear something like the Fed raised rates on Wednesday, and it's the same thing across the world. Japan has its own rates. the Eurozone or the ECB, they have their own rates. And what happens is higher interest rates tend to cause a stronger currency. And this ties into the point below about foreign capital flows, but I'm going to discuss how higher interest rates lead to a stronger currency in general. And because in this day and age of globalization, capital can flow across the world. You can buy, if you have a broker that allows this, or you're a sophisticated investor or an institution, if you're in the U.S., you can invest in investment products all around the world. You know, if you want to buy bonds in Singapore because they have a higher interest rate or a higher yield, you can do that. And this is happening all around the world. So capital is constantly sloshing around across the world and moving into different markets, and they're trying to maximize their investment returns. So one of the ways of doing this is by buying the highest yielding investment products possible, fixed income products, or even just storing money in the form of cash in the bank. If you can get a higher interest rate in another country's bank compared to the U.S., because we have very low interest rates, for example, then it's in your interest to do so if you have enough money to make that worthwhile. So countries that have higher interest rates, provided it's not caused by a major, who had the chance of a major, let's say bankruptcy, or let's say if the government's not bankrupt, if they have higher interest rates because the economy is strong, then capital will tend to flow into that economy and it'll push up those currencies. And this has to do, and this goes to the topic of interest rate differentials. So if you have a difference between two interest rates, like in the case of the U.S., we have a much lower interest rates than many other countries around the world, and that's because of the financial crisis. Even 7 years later, the Fed still has its ZIRP, or zero interest rate policy, to try to boost the economy and stimulate growth and credit growth. But other countries did not have the type of problems that we had. And this includes countries like Australia, Canada, New Zealand, many emerging markets or developing markets, everything from Brazil to Turkey. I mean, many of these countries are now having some problems of their own, but over the past 7 years, many investors wanted to move their money because they wanted to take advantage of higher yielding bonds in other countries. So it's the differential between two countries' interest rates that help to determine which direction capital flows. Now, let's say if the flip side were to happen and all these other countries that once had higher interest rates were to suddenly lower their interest rates. And for example, let's say if they had a financial crisis. And then let's say a few years down the road, the Fed raises its rates. You could see all this international capital flow back into the U.S. and push up the dollar. And in order to understand these rates and how they work, in general, higher interest rates tend to occur at a time when an economy is growing at a faster rate, and also when there's a risk of inflation, where inflation is running fairly hot. The central bank will raise interest rates to try to cool off the economy and try to prevent it from overheating. Conversely, you have a weak economy tends to go along with lower interest rates because central banks want to basically make borrowing costs cheaper. So that's why you see these 0% APR credit card deals and auto financing deals, and that stimulates borrowing. So there's an interest rate cycle that goes along with the economic cycle. Next is monetary stimulus. So if an economy is so bad that having low interest rates or zero interest rates is not considered enough to boost the economy, many central banks will actually do something like quantitative easing. And we've seen that in the UK, Japan, the US for the past 7 years during the financial crisis. And essentially what it involves is creating or growing the money supply. They're essentially printing money. not literally, but the net effect is that they're increasing the money supply by creating new money out of thin air, electronically, of course, and buying high-quality investments, like in the case of Treasury bonds. The U.S. Fed was buying Treasury bonds. And then what it does is it injects all this new liquidity into the economy. And because the money supply is growing, what it does is it weakens the currency against other currencies. So that's the other benefit that central banks see, is that, one, they're putting more money into the economy, and two, they're weakening the currency, which benefits the country's exporters. So that's a major way that central banks can move currencies. And the Japanese yen has weakened significantly over the past 2 years or so, ever since they launched the most recent phase of their quantitative easing or monetary stimulus program known as Abenomics. And it's weakened their currency quite dramatically, and it has helped their exporters. But of course, there are other negative effects of weakening your currency and printing money, and some people believe it causes inflation down the road, but we can always discuss that in some other webinar. Central bank interventions are another major factor that moves currencies. We discussed that earlier in the case of Bank of Japan, Bank of Israel trying to weaken their currencies. Bank of Japan has been known to, there are many times where the yen has been strengthening too much, and Forex traders or Forex participants, mostly institutions, were trying to bet on a rebound or strengthen the yen, and all of a sudden overnight here in the U.S., or sometimes it would just make these surprise moves at almost random times where Bank of Japan would just come in, all of a sudden start to weaken the yen. They would start to sell the yen against usually the dollar and other major currencies. And they try to spook the market, and it sends a message: do not bet on our currency strengthening. And also you have another major factor that moves currencies are politics and geopolitics. So if you have a country that's gone rogue, like let's say in the case of Russia over the past year, the international financial community tends to panic when they see those types of actions, or you have a basically aggressive action and countries not cooperating, and investors want to basically pull out of the economy, and it tends to weaken the currency. There are also other factors like tax policy and repatriation policies and laws that do have some effect on capital flows, but not quite as much as interest rate differentials or other factors, monetary stimulus. But it's still important to be aware of. And there are many different ways of forecasting moves in the Forex market. And different traders have their own styles. And some, including myself, basically like to use a combination of them because you get the best of all worlds. So number one is the most intuitive. It's known as fundamental analysis. And it has to do with analyzing or forecasting fundamental economic information such as interest rates, as we discussed before, GDP, or gross domestic product. That's economic growth in 1 year, or basically the rate that the economy is growing. In general, a faster economy will lead to higher interest rates and currency strength. Inflation rates, employment numbers, many of these are the same. This is the same economic data that a lot of stock traders and bond traders are watching as well, that also have very strong implications for the currency market. And there are many different ways of, actually, pardon me, I just want to ask, some people are asking a question that there's been some difficulty with hearing the sound. If you have any difficulty hearing the sound, can you just type it into the chat bar? And also, if you are having a hard time, sometimes it does help to log off and log back in. That does tend to correct the issue. But if anyone else is having a hard time hearing it, okay, just let me know. Other people are saying it's okay. So if you have a problem, log out and log back in. Thank you, folks. Okay. So we're talking about fundamental analysis and the different ways of analyzing the fundamentals. And you can get very, very sophisticated with fundamental analysis. Really, there are entire economists and entire economic consulting firms that do nothing but forecasting. And that's something we can certainly discuss someday. But, in general, you want to understand the concepts where you have economic strength tends to lead to a stronger currency just because it tends to boost interest rates. Number 2 is technical analysis, which is where you're analyzing price. You're looking at price. You're actually looking at a stock chart, or not a stock chart, but a Forex chart in this case, but it uses similar concepts as stock charts or bond charts or futures charts. They all have similar patterns, and it's a discipline known as technical analysis. And basically the idea behind this is that psychology is a major driver of financial markets. It's not all about GDP numbers or unemployment numbers or inflation, but it's also about what speculators are doing, what speculators think, and if speculators are wrong, and where they place their buy and sell orders, and psychological factors like basic human biases, and also looking at things like volume. How much trading has there been in any given day? Has been light volume or strong volume? Does that mean that money is flowing into the asset in question, or is it flowing out? Also looking at correlations among different markets, and we discussed that. I discussed that in last Friday's webinar. It was called intermarket analysis, and it's basically looking at different markets and how correlated they are, and using that to find signals that have predictive value. So I would look, let's say if okay, for example, the US dollar trades inversely with the Australian dollar. So when the US dollar rises, the Australian dollar typically falls. So one way of going about this would be if I see a certain chart pattern that looks bullish to me in the US dollar, then I would also look at the Australian dollar and say, hey, there's a chance that the Australian dollar is going to fall based on what I'm seeing in the US dollar. And you could get very sophisticated with high-level econometrics. I mean, as I said, people spend entire lifetimes in getting PhDs in these topics, but these are basic concepts, and this is a good way of introducing yourself to them and familiarizing yourself with them. Next is sentiment analysis, and it doesn't really fall into the first two categories, but it is very valuable, and it's using data that is collected from market participants like traders or anyone who's involved with the market in question. And one way of going about this is let's say polling. Like you have political polling, for example. You could poll and see how if traders think that this particular currency is going to go up or down, and what's interesting is that when many traders think the same thing, they tend to be wrong. And that's known as contrarian thinking or type of contrarian logic where the crowd is always wrong. And sentiment analysis is very useful for this type of trading or analysis where you want to see when everyone's doing the same thing, you want to do the opposite. So if everyone is bullish on the US dollar, you may want to consider doing the opposite. And I'm going to show you specific slides that prove how well this works, and you'll see it in a visual manner shortly. And then also political analysis. If you're a political analyst, that's not my particular forte, but I could see a role for it in this type of trading where you want to analyze geopolitics, or let's say if you knew in advance that Vladimir Putin was going to invade Ukraine and basically go rogue, you could have shorted the ruble and other Eastern European currencies. So that's another strategy that some traders and hedge funds follow. And I like to use a combination of them to get the best of all worlds. Just want to discuss some famous Forex traders. There are really countless very, very successful Forex traders. Most of them are institutional traders, hedge fund traders. You know, you can have individual traders on certain bank Forex desks who are making millions and millions of dollars a year, and they're in their late 20s and or 30s. It's pretty remarkable. Or you have individual hedge fund traders who you've never even heard of and have never even been in a single news article, but are making millions of dollars a year trading Forex and just laying low, which is kind of nice in some way. But some very prominent ones that you'll see time and time again are, number one, George Soros. And he became known for other things, obviously, but one of his main feats in the world of Forex is that he broke the Bank of England on what was known as Black Wednesday, September 16th, 1992. And through using his fund, which managed billions of dollars, he basically bet against the British pound, and he bet that Britain was going to leave what was known at the time as the European exchange rate mechanism, where it was tied to other European currencies, and he bet that they were going to leave and that their currency was going to weaken significantly. And with his capital, he gave them a little bit of a push. He wasn't just a passive participant in the market. He became an active participant. When you have that much money and influence, you can move the market in your favor. So that's something to look forward to. If you get good enough, you don't have to wait for certain moves to go in your direction. You may actually play a role in causing a certain market move, and that's exactly what Soros did. He made $1 billion in one day. I believe it was one day, either one day or a few days when the pound crashed. Pretty remarkable, and you can see George Soros pictured right there. And lately he's become, well, not lately, he's been controversial for a while, and certainly in the late 90s when he was betting against, back in 1997 and 96, he was betting against Southeast Asian currencies, including the Malaysian ringgit. And he was betting that there was going to be a crisis, and he made a fortune as those currencies melted down in the Asian financial crisis and the emerging markets crisis. And he was blamed by the Malaysian Prime Minister Mahathir Mohamad. He was really the Prime Minister lashed out against George Soros and claimed that he was colluding with other financiers to try to hold back these emerging economies. So, depending on your view, you may not agree with it, but that's what was said about him. The fact is that those emerging markets had bubbles. They had economic bubbles, similar to what we saw 10 years ago in the U.S., but of course, in a way that emerging markets tend to have. Emerging market countries like Malaysia, Indonesia, tend to have financial crises every 10 to 15 years, at least in the past. So there was a bubble due to, I believe it was due to cheap money that created all sorts of imbalances and rapid credit growth throughout much of the 90s, and this is when these economies were known as the Asian tigers. And they were growing very rapidly through the export of various products, and then they had real estate bubbles. You know, so much capital just flowed into these economies for so many years, and it led to what's known as malinvestment, or when you have major investments such as infrastructure or countless apartment buildings being built, or property prices are soaring, and then the bubble pops. It leads to what's known as malinvestment, where these apartment buildings, these hotels, these casinos are no longer useful or no longer economic, after the crash. So I don't believe George Soros caused the crash per se. I believe the crash would have happened with or without George Soros. And in a global free market, you're free to take advantage of these trends and to buy and sell. So another one is Bill Lipschutz, another fairly well-known hedge fund manager. He's reported to have made $300 million in 1 year in Forex. And another one named Andrew Krieger, and he made $300 million by betting against the New Zealand dollar in 1987. So one of the benefits of Forex is that you can move massive amounts of capital in and out of it just because it's so liquid. And that's why hedge funds and hedge fund traders tend to gravitate to Forex, because you're able to move the large amounts of money that they manage. Whereas if you have small cap stocks or other illiquid instruments, they may not be able to handle the kind of trading volume that these larger hedge funds require. So Forex is hardly some fly-by-night market, even though most people aren't aware of it. It's really what the smart money and the big money are playing. So makes it very interesting and worth following. And that ties into this next slide and next concept of following the smart money. How do you follow the smart money? And that's a major theme of mine in all my trading and all of my analyses. Is I want to know what the smart money is doing in each market, if I can. And there are various ways of doing this. I'm going to discuss one way of doing it. And as I showed you in the first bullet point, I try to follow the smart money and do the opposite of the dumb money. I'm going to show you how to do that. And one of my favorite smart money indicators is known as, or it's derived from the U.S. commitment. It's called the Commitment of Traders Report from the Commodities Futures Trading Commission, or CFTC. And they report the different positioning of 3 major market participants. And one is large traders, like you have large CTAs or commodity trading advisors or funds that manage investor capital, and they move them in and out, and they tend to trade in a trend following or technical manner. The next are the hedgers, and these are known as the smart money, believe it or not. I'll explain why. But these are institutions that are using the currency futures market and the currency market to hedge their exposure to the currencies. So very often it's large importers or exporters that stand to gain or lose billions of dollars on currency fluctuations. So they've hired top economists to try to forecast the market, but also they're aware of the market more so than other participants because they are the market. You know, when you have these major institutions that are moving billions and billions of dollars per year, and they're able to ascertain real demand for currencies and trends and forecasting sales and future exports, they have an edge over other participants. And it also includes some large commercial banks that deal with hedging and also currency conversions. That's part of it. And commercial hedgers, the smart money, are actually not speculators, even though they tend to be very accurate. Ironically, they're not typically using it for their own gain, to try to profit from the moves. They're just doing it to protect their own profits while they focus on their main core business activity, which is selling or exporting widgets or selling cars, you know. And also discussing how to track the dumb money. The dumb money trades in an opposite manner to the smart money, and they trade in a diametrically opposite manner, as I'll show you in the coming charts. And this is according to the Commitment of Traders Report. The dumb money are typically large trend-following funds, and they're not dumb people. These are, you know, very well-educated people. Many of them are, you know, Harvard, Ivy League, MBAs, but they become the dumb money at specific times, and that's when they all tend to cluster and do the same thing at once. So that's when they become the dumb money, and that's typically at major market turning points, and the market tends to move against them when they all think the same thing. When there's this group consensus or group think, where everyone thinks that one currency is going to go up, and they all position themselves accordingly to try to profit from this. That's most likely when the market's going to turn exactly against them. And the same thing happens on the flip side. If they're all bearish on a currency like the euro, they believe the euro is going to break up, and they all position themselves to short the euro, chances are the euro is going to move against them and rise, and they're going to lose. I'm going to show you that very shortly. And the reason why the dumb money tends to be wrong is because their extreme speculative positions lead to what's known as crowded trades. And those crowded trades must eventually be unwound. And the unwinding process of those trades, closing out those speculative positions, usually leads to powerful moves, and it moves against these speculators in favor of the commercial hedgers. And for example, if you're short a currency, or if all these large traders are shorting a currency, they have no other choice at some point but to close their position. They have to buy back the currency, and that's going to create upward pressure on that currency. And when they all have a similar position, it's like yelling fire in a crowded movie theater. They're all trying to get out at once. So I'm just showing you right now how the smart money and the dumb money position themselves, and how often they're right and wrong. I'm showing you right now, this is the euro over the past 5 years. And you can find these charts on what's known as finviz.com, finviz.com, or many other data providers that provide this commitment of traders information for free. And I find it very useful. But I like finviz.com because it shows it right underneath the chart and updates in real time throughout the day. And you can see here the commercial hedgers, or smart money, are the people, you can see it's the green line underneath each of these charts. And the large traders of dumb money are the red lines. And on the y-axis, you have the number of contracts that they have in each futures market. In this case, it's the futures market on the euro. So you can see over here back in early to mid 2010, this is a time when, right after the pigs crisis just started to unfold, peripheral European crisis where Greece, Ireland, Portugal, etc., many traders were expecting, or participants were expecting, that there was going to be a breakup of the Eurozone, and that there was going to be a meltdown in the euro. And you can see the large traders were heavily short. I believe they had 150,000 or so short contracts against the euro. So they were placing a fairly large bet that this was going to go down, and down hard. Yet the commercial hedgers did the exact opposite. They took pretty much the same position, just under 200,000 net bullish contracts, or long contracts, betting that the euro was going to rebound. There was going to be some sort of a resolution. And sure enough, the ECB came up with its LTRO plan, or other types of plans to try to shore up confidence in the economy, and also the financial system there in the Eurozone. And obviously, as we know, it didn't break up, and the euro rebounded, and the commercials were correct in the directional move, and large traders lost out. Then we saw a similar situation just 2 years later, summer of 2012. There was a lot of fear that Greece was going to leave the Eurozone, so you had the large traders were betting against the euro once again. And the commercials said, nope, you guys are wrong. You were wrong last time. You're probably going to be wrong this time. Sure enough, the commercials were right. And you had a rally for almost 2 years after that, up until early 2014. And once again, here we are. A lot of fear about Greece lately, and Also, part of the reason why the euro had been weakening for the past 7, 8, 9 months was because of the upcoming QE program that the ECB, or European Central Bank, was going to launch, which launched just a few weeks ago. And many traders were expecting that they were going to launch this program, and they did, and it's 60 billion euros per month that they're printing electronically to try to weaken the currency and boost exports and to try to pump liquidity into the European financial system to try to create an economic recovery. So obviously there was a very good bet at one point to short the euro back 8, 9 months ago, but now you have these large traders are heavily betting that the euro is going to weaken even more. And just you tell me, what happened the last 2 times they did that? They were wrong. And the commercial hedgers and the smart money are betting that the large traders, the dumb money, are going to be wrong. So I want to bet with the smart money. And what's interesting right here is you look, there was a recent technical breakdown. This goes back to technical analysis, or charting, as I discussed, is one of the forecasting methods of Forex. And you can see the euro broke below a key psychological level at 1.2 to the US dollar. That was a major breakdown. And there also is a chance that the euro can continue to weaken in the longer run. They're going to keep on running this QE program until at least September 2016. And let's face it, Europe is a basket case. I don't see anything changing with them anytime soon. They are just so saturated with debt, and their demographic situation is really deplorable as far as the ratio of non-working people to working people due to basically aging and demographic trends like that, where you have a high number of dependents to workers. So that, and it's going to get worse over the next few years, similar to Japan. And when you have a massive aging problem like that, it does not lead to vibrant economies. It leads to slow economic growth, stagnations. So there's a chance that the euro can keep on weakening in the longer run, but it appears that the commercial hedgers are betting at least on some sort of a rebound. So it wouldn't be too surprising to see the euro maybe try to go retest that resistance at 1.2, just because that's the most obvious resistance, or that's most obvious psychological or technical level on the chart that I'm seeing. So I'm curious if that's going to happen at some point in the near future. It looks there has been a little bit of a rebound or strengthening in the euro over the past week or so. So we'll see if that trend has legs and if it can continue on, and maybe we'll see if the euro will strengthen. And then it's very possible if the euro strengthens, maybe the commercial hedgers will no longer be as bullish on it. And that's what happens when the market goes in the direction of the commercial hedgers. They'll then cut back their positions. So if the euro starts to rise, you'll see the commercial hedgers drop their futures positions and go back to zero again, and then it could possibly set up for another bearish trend. So I see a lot of questions coming in. I'm going to answer these questions at the end during the Q&A. So I'll definitely, think of some questions. I'll do my best to answer them until I just want to finish these next few slides, and then we'll get into that discussion. This is the U.S. dollar index. I always look at the U.S. dollar index. The U.S. dollar index is basically an average. It's an index that's constructed to try to derive the value of or the strength of the U.S. dollar against its major trading partners. And you have major currencies like the euro and the yen have the highest weighting in this U.S. dollar index. And I find it's very helpful as an indicator to look at the U.S. dollar index and to perform technical analyses on the U.S. dollar index to try to figure out what the next move is, either in the dollar but also in currencies that are correlated. A lot of them move inversely against the U.S. dollar. So if you're expecting dollar strength, then you probably expect weakness in the other currencies. So I just want to show you that the commercial hedgers of the smart money have the largest bearish position that they've had on the U.S. dollar index in at least 5 years. This chart only goes back 5 years, but this could go back even further. So this is a fairly extreme position. And the dumb money, large traders, have 75,000 net contracts. They're long on the U.S. dollar, meaning they're expecting a continuation of the trends of the past 7 months. So, and the U.S. dollar trades inversely with the euro. So as I was saying, that the smart money expects the euro to rebound, and the smart money expects the U.S. dollar to pull back. So there's a good chance, at least, that there could be some sort of a reversal, even if it's temporary, of the Forex trends of the past 7-8 months. So just keep that in mind. I'm not predicting and saying this is guaranteed, but I like to look at high probability scenarios, and I believe that the commercial hedgers and the large traders have a fairly good track record, enough for me to pay attention and take note. British pound, it's another one that trades inversely with the U.S. dollar, and it's positively correlated with the euro, meaning it trades in a similar manner, not identically, but similar enough. And you can see it's been pardon me, it's been weakening for the past 7-8 months. And sure enough, commercial hedgers are long, just like they were back in early 2013 and early 2010. And you have the large traders are betting on further declines. So, pardon me, I'm just going to clear my throat. I'll be right back. Don't worry. Okay, folks, I'm back. Sorry about that. Thanks for understanding. All right, so you have these large traders are betting that the British pound is going to continue to weaken. And what I drew over here, you can see that blue line is known as a downtrend line. It acts as a technical resistance line. So I'm curious about this scenario and looking for possible trade setups that, let's say, when or if these commercial hedgers are right and there's a rebound in the British pound, one possible trigger for me to know that there's going to be a rebound would be a break above that trend line, which is acting as a resistance line. And it's significant because it goes back for 7-8 months. So, and you can see the British pound has touched that so many times, which adds to the significance of that line. So I want to see, you can draw that on your own charts. If you're a cash currency trader, you can look at the GBP USD or British pound US dollar currency pair, and you can draw that line yourself going back to, I believe, July 2014. You can draw that line and watch it on your own time. And if the British pound starts to rise above that, that could be a possible setup. And I'm not giving investment advice, telling you to buy or anything. I'm just saying keep your eyes on this. Australia dollar, it's another currency that trades inversely with the US dollar index or US dollar. Tends to be positively correlated with the other currencies, the euro and the British pound, but even more so, the Australian dollar is correlated with commodities prices, particularly iron ore. And that's one of the major exports. They export to China. Iron ore prices have been imploding over the past year and a half or so because China's been slowing down, so you can see that weakness in the Australian dollar. But the commercial hedgers of smart money are betting that this trend could end very soon and that there could be a reversal. You can see in the green, they're long and they've been accurate in the past. And similar to the British pound, there's a downtrend line, a resistance line. You can see I drew it in blue. So if there's a break above that, that would be at least one indication, not the only indication or trigger or confirmation I would use, but it would definitely be something that's worth taking note of if the Australian dollar versus US dollar can break above that level, because it has psychological significance. There are many traders who are watching these same trend lines, and there are many algorithms that hedge funds run or major banks run that are looking at the same thing. And when there's a breakout above a certain psychological level, it tends to trigger orders. In this case, it'd probably be buy orders. So some people don't believe in technical analysis, and I believe they're wrong. But the fact is, the market and enough market participants who are trading big capital are looking at technical analysis, and that alone, whether you agree with the logic behind it, that alone is why I believe everyone should pay attention to charts and key psychological levels. The New Zealand dollar, there seems to be the commercial hedgers have a fairly bullish position relative to their positions in the past. They tend to have a net short position over the longer run, and when they have a slightly positive position, that usually happens before a major appreciation of the New Zealand dollar against the U.S. dollar. So I pay attention to that. I mean, they don't have a wildly bullish position, but it's definitely something where, you know, in the not too distant future, maybe there could be a rebound. So I just wanted to discuss, you know, what is the smart money telling us after seeing all their positioning in the Forex market? What can we surmise or conclude from all this? And I just want to start with a caveat saying beware that the smart money can be early. Because they are hedgers and not speculators, timing is not as critical to them because they're not concerned about mark-to-market losses the way speculators are, whether they're retail or institutional. These hedgers they're using the futures market, using the Forex market just to ensure that they're not going to lose profits that they made overseas that are denominated in another currency. So they can be early. Like when you see a steep decline in a certain currency, they tend to start accumulating their position quietly and slowly until they've built up their full position. So they tend to be a little early. So just the fact that commercials are long is not an automatic sign to buy because they could really go against you for a time until the commercials are proven right. And they're not always right, but they have a general tendency to be right. And that's why I look at other indicators for confirmation of actual trade triggers. So I was discussing the implications of how these commercial hedgers, dumb money and smart money, are positioned. And it may be right now that these commercial hedgers suspect that this long dollar or bullish U.S. dollar and short everything else trade or trend of the past 7-8 months has become a crowded trade and that there could be some sort of a reversal sometime soon. So I want to write an article about this. I've been kind of discussing this for the past week or so. I've been very busy, but hopefully this weekend I can do this and I can send it out to you guys. And another scenario that the smart money may be thinking of is some sort of a QE-related disappointment in Europe, where let's say it doesn't work as planned or it's not unfolding the way the optimists had expected, and it's possible that there could be a rebound in the euro, believe it or not. This is actually what happened in Japan for the past 2 years, where every time traders became concerned that Japan's monetary policies weren't working, the yen actually rallied because they're basically they want to be in cash because they're concerned about being in other more volatile assets. So they try to buy up cash. So I'm just curious if that, one way that this could play out. Another way could be a dovish monetary shift at the Fed due to deflation fears. I wrote this slide a couple weeks ago. Maybe it's a little less likely just because of today's strong jobs report, but we'll keep watching. You had this major commodities bust over the past 7-8 months. Oil prices crashed, and if there's a chance that the Fed doesn't hit the inflation numbers that it expects or desires, that they may try to push off an eventual Fed funds rate hike, and that could cause the dollar to pull back and in turn cause the euro to rebound a bit. Just throwing out different scenarios, no predictions here. Just want to show you another thing to be aware of. The dollar index recently broke out, and this is a technical breakout. If you look at the long-term chart, it goes back to the year 2000. There was a major psychological level at 93, and that marked the lows in early 2003, early 2004, late 2005, and now here we are almost 12 years later, and really in the start of this month, or the start of January, the dollar index broke above that psychological level at 93. So that's a fairly significant technical breakout, and I'm curious if that is going to lead to further strength. And I can discuss these possible bullish scenarios that in the longer run, even if the commercial hedges and smart money are right about the reversal over the next maybe 6 months or a few months, here are possible reasons why in the longer run, let's say maybe after 6 months, why the dollar may keep on rising. And one of them could be that the euro may weaken a bit further as the ECB's QE starts in March. Maybe once it actually gets into gear and the ECB starts debasing its currency and buying these assets and increasing the supply of euros, that it could lead to euro weakness. I mean, chances are this scenario is probably already priced into the market, meaning it's already factored into today's prices, but it's one possible scenario. Another one is if the European economy continues to stagnate, which I do expect in the longer run, it could lead to expectations of QE, quantitative easing, even beyond September 2016. Let's say if it just doesn't recover the way people are expecting right now, they may have to keep on running this program and keep on printing, and that could continue to weaken the euro, and in turn that would favor the dollar, or the cleanest of the dirty shirts, as it's being known as over the past 8 months during this bull market. Another dollar bullish scenario is if the Japanese economy keeps on stagnating, which I also expect, just like Europe, because they're just so saturated with debt. I believe their government debt to GDP ratio is over 200% right now, whereas the U.S. has been hovering around 100%. And they have an aging problem, which is what we discussed about earlier about demographics, where you just have too many people who are of retirement age compared to the number of workers. So that leads to a stagnating economy, not a vibrant economy. And demographics really do play a very, very, very key role in economic trends and how strong economies grow. Like when you have a large number of working age people compared to dependents, whether that's children or the elderly, those tend to be fast-growing economies. People are in their prime earning and consuming years, and they're starting families, buying houses, and that leads to a fast-growing economy. That's one of the reasons why back in the 1950s in the United States we had such a fast-growing economy, was because of the post-World War II baby boom. You had all these new young families, and they're going out and buying houses, and suburban sprawl was occurring at that time. And so Japan is extremely stagnant. I don't expect that to change. Their demographic trends look to be down for at least a decade or two, unfortunately. And with the amount of debt they have, I'm not optimistic. So chances are Bank of Japan is going to have to just keep on printing money, just debase that currency to oblivion pretty much. And that benefits the cleanest of the dirty shirts, and that's the dollar. Another possible dollar bullish scenario is the unwinding of what's known as the U.S. dollar carry trade. I'm going to discuss that next slide. But in this scenario, the dollar would soar and foreign currencies would continue to sell off. I'll discuss what that carry trade is. Over the past 6+ years of ZIRP, or zero interest rate policy in the United States, hedge funds and other institutions took advantage of those ultra-low borrowing costs in the U.S., and they borrowed in U.S. dollars, and they invested it in those higher interest rate currencies and countries. As we discussed earlier, interest rate differentials and interest rates help to determine currency trends. So in this case, you have so many hedge funds saying, hey, we can borrow, maybe 1-2% in the U.S., and we can buy bonds in an emerging market that are yielding 5-6-7% or so, and then pocket the difference. And then they lever it up because it's borrowed money. So let's say if they can earn a 3% differential, maybe they can lever it up so that they're making 10, 15, 20, 30% return per year. And that's been one of the major trends over the past 6-7 years, is this dollar carry trade. Many institutions basically made their bread just by doing these carry trades because it's free money really coming from the Fed. And this trend has boosted those non-U.S. currencies against the U.S. dollar up until the past 7 months. It appears to be at the very early stages of unwinding, but it hasn't fully unwound yet. And this dollar carry trade is worth trillions of dollars, trillions and trillions of dollars. So it is very significant and momentous, and very few people are aware of it, yet you have this massive amount of capital that just flowed from the United States and also Japan into emerging markets in Australia and Canada, and what it's done was it boosted their currencies, and also the assets that trade in those currencies, like the bonds that trade in those countries. They basically benefited from this massive flow of capital into those bonds, into the stocks, and what it did was it created economic bubbles in those various each of those countries' property markets, bond markets, sometimes stock markets. So my concern is that the eventual ending of U.S. ZIRP, or zero interest rate policy, plus the rally of the U.S. dollar could cause this entire carry trade of the past 7 years to unwind and reverse. And that could lead to a dollar short squeeze. It could really harm or cause these foreign currencies to depreciate. And the reason why is because any institution that's involved or was involved with a carry trade was basically shorting the U.S. dollar. They owe U.S. dollars. They have loans in U.S. dollars that eventually need to be paid back. So if the U.S. dollar is rallying and strengthening, and the currency that they invested in is weakening, they're going to owe much more, not in dollar terms, but due to the exchange rate, they're going to lose out on that trade, and they're going to possibly owe a lot of money and possibly be wiped out. So that's the risk, is you have this dollar rally that could basically create a perpetuating cycle, and that could cause a longer-term dollar bull market that I'm concerned about. So, all right, so I have many different slides. I'm just going to go through these really quickly, and then we'll go to the questions. So just want to show just a short-term analysis. As I said, I start with the U.S. dollar index first. You can see U.S. dollar index has been in an uptrend over the past 7 months. It's steep. This uptrend steepened since mid-December, and now I'm seeing what looks like a possible flag pattern. You can see these two parallel lines. It looks like a small rectangle. It's known as a flag pattern. So I want to see if there could be a breakout from here, a bullish breakout to the upside. You can see right underneath you have this rising uptrend line that should provide a support, and then you have that flag. So if it rises above there, we could see further bullish action. On the other hand, if it breaks below that rising uptrend line, That started mid-December. Then you can see the U.S. dollar correct and maybe correct back to the uptrend line that began this past summer. So that's what I'm watching in the U.S. dollar, and it has implications for non-U.S. currencies. Like, as I said, if you're bullish on the dollar or you see a bullish dollar breakout, that could be a sign that there could be a weakening, at least in the short term, in other currencies that trade inversely. This is the euro, trades inversely with the dollar. It looks almost identical, and that's because the euro has the highest weighting in the U.S. dollar index. Again, we see a possible flag pattern. So I want to see how this plays out. I don't know how it's going to play out in advance, but I don't have to, because all I have to do is react when there's a breakout or breakdown. But I want to see if this little channel here over the past couple weeks is a flag pattern. So keep your eyes on that. The Japanese yen. This is very interesting, and I wrote a column recently on Forbes.com, and I showed this pattern in the yen, and it looks like a possible triangle. It's a technical pattern, common chart pattern, and they tend to be continuation moves, meaning whatever move led into the triangle, which in this case was a downtrend from August 2014 up until early December 2014, whatever that move is, it tends to continue when the triangle is basically when the triangle resolves, or when there's a breakout or breakdown. So, and I showed that there was a breakdown today, and it's related to the strong U.S. jobs report. But that's if you're a Forex trader, I'm not recommending you do this, but just watch that there could be a weakening in the yen if assuming that this breakdown in the yen holds. If it reverses back, then all bets are off. But I'm going to keep my eyes on this. It's very interesting. And I'm showing you the chart of the Japanese yen futures just because it's a little more intuitive that when this chart, or when you see it fall, it means that the yen is weakening. When you see it rise, it means the yen is strengthening. But most Forex traders are trading the currency pair known as the dollar-yen. So when the yen is weakening, the dollar-yen is actually rising. So it's the inverse. It can get a little confusing. But if you have a Forex account and you look at the dollar-yen, you'll see this chart. It'll just be flipped. So it looks like an upside breakout from that triangle. And the prior trend in this past summer and early fall, the prior trend was that the U.S. or the dollar-yen was rising. So I want to see if the dollar-yen is going to strengthen, and if the Japanese yen futures you see here are going to weaken. This is the British pound short-term chart. You can see that downtrend resistance line that I showed on the longer-term chart a few slides ago. So it looks like it seemed to have sold off a bit after bumping its head here. So let's see if it can either break above and maybe continue rising. I also see a resistance level at 1.55. Let's say if I were to play this in a bullish manner, I would want to see a break above both of those resistance levels, both the downtrend line, which is the diagonal line, and also this horizontal line at 1.55 as confirmation. On the other hand, let's say the British pound just can't break above and it bumps its head and falls back down to that support at 1.5 against the U.S. dollar. I want to see if it can break that support and maybe drop even further. So I don't know how it's going to break out, but I'm just going to watch. I'm going to watch. You should just keep these levels and these lines in mind. Australian dollar, similar downtrend line. There's a possible flag pattern that's been forming, or this little mini consolidation range over here for the past week or so. So I want to see if it's going to break out, if it's going to break to the upside or break to the downside. But it looks like that has some significance as a consolidation zone. This is the Canadian dollar, similar pattern as the others. You see these steepening downtrend lines that act as resistance lines. It appears to have been consolidating for the past few weeks. I want to see if it maybe forms a pennant pattern, which essentially a pennant looks like a small triangle on a chart. And these are patterns that show up pretty frequently, and they do tend to be accurate. So I just want to see if it's going to continue forming this little triangle, and if it's going to break up or break down from there. And the prior trend was down, so it tends to be biased whenever you have a pennant. Let's say there's a downtrend that leads into it, tends to be biased to the downside when there's a breakout or breakdown. And the flip side is also true. If you have a rally and then a pennant forms, there's a greater chance than not that it's going to continue on to the upside if the pennant breaks out. So, right. And as someone just said, Canadian dollar is highly correlated with crude oil. I actually wrote an entire column about that back in late December, and I was showing, I don't know if you can see it, but it looks like there was a small pennant that formed from mid-December to late December. It looks like just look a small triangle. And I said if that breaks down, and I showed a similar pennant in crude oil, and I said if these two patterns break down, you could see a significant weakening of Canadian dollar and oil. And sure enough, that is exactly what happened. So that would have been a nice trade for anyone who took that. So I want to see what's going on lately with Canadian dollar, if that's actually a pennant or not. So we'll see. All right, so it's not over yet. We're still going to do a Q&A, but I just want to discuss, we do have a special deal where if you want to learn more, and there is much more to learn because I only showed you probably 1/10 of 1% or less of what there is to know about Forex and what I could probably discuss about Forex and other market trends. So there's much more where that came from, and I'm teaching other courses with Cyber Trading University. I'd love to see you come in to these webinars and ask me questions and learn and become successful traders yourself so that you can, who knows, maybe you could become a successful trader like George Soros. I'm not saying you will, but let's put it this way, you can increase the chances of getting on that path. Or at least doing quite well for yourself. There are people who make a living as Forex traders, so I think that's well worth it. And what's nice is that we have this deal where you get over $4,000 worth of Forex courses taught by myself and also by former instructors who have recorded their courses, and you can still watch them. So over $4,000 worth of these courses, and all you need to do is just open up an FXCM trading account and pay $40. That's all you need to do, literally. And you just get this massive treasure trove worth of education. And we're going to be continuing. I'm going to keep on making all sorts of new, novel, exciting, informative courses that you'll be privy to for free. I mean, once you take advantage of this deal. So I think that's well worth it. In addition, and I'm going to give you the link to that right now. I'm going to put this right here into this chat box right over here, and you can just click on it. You can order directly from there. So I'm going to keep discussing what else you get with this package. You also get 1 week of free access to Cyber Trading University's ever popular cyber group chat room. And do not underestimate this. It really is phenomenal, and I have been in there for quite some time, and I've been watching Rich Lepis, who's one of the instructors who's very active in there, and obviously our CEO and founder, Fausto Puglisi. And you can see them live trading. They focus primarily on day trading, very active NASDAQ stocks, and I'm seeing Rich and Fausto personally, I'm seeing their accounts. They're making big money trading this. I wouldn't put my reputation on the line, and if I didn't really believe this and see this with my own eyes. And at first I was like, are they really doing this? And they are. So I'm learning from them when it comes to what they're doing with intraday stock trading, because they focus heavily on using level 2 and total view to trade intraday NASDAQ stocks. And they've really got it down to a science and an art as well, where they're trading constantly, and they're picking these big moves before they happen, and they're posting it in the cyber group chat room. So it's not like they're putting out these calls in hindsight, like, oh yeah, I bought this and it rallied. No, they're saying, watch this stock because it's going to move, and Rich will actually put, big money behind it, and so will Fausto. So come on in, it's free access. You get to go in, and you can ask them questions, and also I'm in there too throughout the day. I do trade stocks myself, and at 4 p.m. every day, Eastern Standard Time, I do a Forex and futures and swing trading recap that has been very popular. So a lot of people have been really enjoying that, and I definitely want to continue to improve and evolve and refine that daily meeting. So you get to have that type of guidance with Forex trading. So you can, if you click on that link, you can learn more and you can enroll. And I also recommend that you call that number, 877-702-9237. I'm going to put it in. So you can call in if you want to speak to an education advisor, and you can talk and discuss what you're looking to do, and they can come up with a solution that is optimal for you. And it's a phenomenal deal. In addition, if you, let's say you do order this, which I recommend, and you open up an FXCM account and you get all these free courses, I'm actually teaching my next live Forex class this coming Tuesday. There's 2 sessions, 5:30 and 7:30 p.m. This is known as the Phase 2 course. It's a little bit more advanced, but it's with the knowledge that I taught you today in this webinar, you should have a good grasp, and I'm going to go over some of the basic concepts, but you'll be able to access recordings of the Phase 1 and watch the recordings of the Phase 2, and you could watch it a million times if you want to. So, and many of our, what's interesting is many of our CTU traders, actually, CTU clients are watching past webinars that Fausto gave or Rich gave a long time ago, and they watch it over and over and over and over. And these are successful traders. These are not novices, but they do it for the sake of repetition. It's almost like a form of muscle memory. You just want to keep on soaking it in and absorbing. And I do the same thing with trading reference books that I have been reading since I was in high school. I keep on going back to them over and over, but just I want to soak in that knowledge. So you get to do that for free. It's really not a bad deal, and you get to try your hand at the Forex market. You don't have to bet $10,000, $20,000, $100,000. You can really start trading Forex with only just $1,000 or so, meaning putting that actually in the market, or even a couple $100 sometimes, depending on what size contract you go with, or what size lot, as it's known in Forex. So what's nice is you get to try out these concepts as you learn. You don't have to risk big money, but at the very least, you're still trading real money. So you become a market participant yourself, and at least it feels real to you. And you'll have this type of guidance. So I'd say come on in and let's start dominating the Forex market. Let's become the next George Soros. It's possible, right? If you have enough people in this trading room, enough people who are following, chances are there's going to be a certain percentage who are actually going to be successful Forex traders, just due to sheer probability alone. So it's definitely inspiring. So, all right. So now we're going to have the Q&A session where you can ask me questions about Forex. You can ask me global economic trends, economic bubbles, what I'm going to eat for dinner tonight, you name it. So, and if you can, if you're one of my social media followers who knows me through Facebook, Twitter, etc., if you can kindly notify me, I'd like to see that, just out of my own curiosity. I'd like to give you guys a shout out and say hello. Ellen asks me, do we have a separate room in our cyber group for Forex? At the moment, we don't, but I just started as the Forex instructor here just a few weeks ago. So I'm only starting to be building up the Forex program here at Cyber Trading University. So it's really in its infancy, and my goal is to to get many people in here to have enough of a critical mass of skilled Forex traders where we can justify having a separate room. And definitely, you know, we would love to go about and do that. And I have my own followers, you know, out of the 100,000 or so social media followers I have, and many others who I'd say, hey, you know, if you want to play the markets, this is one way of going about it. So we're going to be getting, you know, probably a lot more people into this, and there's already been a tremendous response since not to toot my own horn, but there's been a phenomenal response ever since I started as the instructor. We have people calling in to the office and emailing, and just, I appreciate all your support, and it's definitely encouraging and definitely makes me want to press on and make some nice new content for you guys. All right, let me see the other question. All right, Pete asks me what happened to the Swiss franc. All right, I'm going to actually show you a chart and then tell you what happened to the Swiss franc. How about that? Because I'm all about charts. That's just my fixation is charts. I love charts. I am a visual learner and a visual thinker. I've always been like that. And I find charts and charting, financial markets tend to be more intuitive to me than, let's say, just seeing raw economic data that's listed in a text-based or just numbers in a table. I like to visualize it. So, and I'm sure many of you are the same way. And humans are visual animals. You know, so it's really not that surprising. I'm sure it goes all the way back to evolution, where we're looking out for predators with our eyes, right? So we're very visually oriented. So it's not surprising that it tends to help visualizing financial markets. So I'm going to show you the Swiss franc. This is in mid-January, and what happened was the Swiss franc basically exploded anywhere from 20 to 35%, depending on the currency that it was trading against. And what happened was, starting in 2011, the Swiss franc was pegged to the euro. The SNB, or Swiss National Bank, tied the value or the exchange rate of the Swiss franc to the euro, because the euro was weakening significantly at that time. And what was happening is Europeans in these other countries that were not Switzerland were basically pulling out their capital from Greece and from Spain and other similar countries, and they were putting it to Swiss banks and other Swiss assets. And what it was doing was putting upward pressure on the Swiss franc, so much so that it was actually harming the country's exports due to the currency strength. And as I said earlier, central banks, most of the time when they intervene, it's to weaken their currency, to not to strengthen it, unless there's a major currency crash and they raise interest rates. That's a different story. But a lot of the time, central banks are trying to weaken their currency. So the way that the Swiss National Bank did that was to tie it to the euro, so that there wouldn't be too much of a differential between the two currencies. And you can see in 2011 there was this significant appreciation in the Swiss franc, and you see where it topped out around 1.4. That was basically when the Swiss franc was pegged. So what happened recently, which was when the ECB was launching its quantitative easing program, and it was causing the euro to weaken, the SNB said, okay, we've had enough. We don't want our currency to weaken this much, and they unpegged it. So, of course, the Swiss franc found its new level as determined by the market. It was price discovery at that moment. And I'm talking within 5 minutes. And this shocked the world because the SNB didn't even hint. Actually, within a few days earlier, they were pretending or acting as if they intended to keep the peg. So this was really the shot heard around the world. Almost nobody was expecting this. And a lot of traders and hedge funds got hit hard by this. And I just want to tell you one way of avoiding this type of this type of crisis in your own trading if you're trading currencies. And a lot of people were spooked from Forex, and it's definitely something that you really have to take a step back and really ponder about. But I've come up with a realization that here's how to avoid this type of scenario. It's simply this: don't trade pegged currencies. If there's a currency that you're trading that has a peg, just don't do it, because there's a chance that they could unpeg it, and then you have a major sharp move like that. And thankfully, there are no major pegged currencies that are tradable by retail traders. The Hong Kong dollar, for example, is pegged to the U.S. dollar, but that's not tradable. You can't. FXCM doesn't offer trading on it. Neither does Owanda or other major brokers. So you can't even trade it. So you can't even get yourself into trouble in that manner. So in a way, it's a good thing. I think it's a good thing. So right now, the euro is not going to make a move like that, or the yen is not going to make a move like that, because they're not pegged. So, and there will be big moves over time, but it's not going to be something where it soars 30% or 20% in all of about a few minutes, So that's one way. Another way is don't trade with excessive leverage. I know with Forex you can get up to 50 to 1 leverage, but I would not take full advantage of that. Even 10 to 1 is a lot of leverage. I mean, it's if you're trading, if you have only $2,000 in your account and it's 10 to 1, you're trading $20,000. That's quite a bit of leverage there. And too much leverage actually hurts your trading returns. Even though you think, oh, I can make more money if the market moves in my favor. Yeah, but if it moves against you, and chances are it's going to cause you to panic out of your trade just because you're trading too large and you're not able to think clearly. So avoid excessive leverage. Don't trade pegged currencies. Those are pretty much, if you follow those rules. Oh, also I would use a stop loss order just to protect yourself against a move against you. Have an electronic stop loss. All the major brokers offer it, where if it moves against you, you're out. You can set a limit, like I don't want to lose more than 1% of my total account value on any one given trade. That's a common one. If it gets out, even if you have to take a small loss, you're better off taking a 1% loss instead of a 10, 20, 30, 40% loss. So for me, I always have to have stop loss orders. It's just for the peace of mind. It's so worth it. Let me see the other questions. Sue asks me, do you trade fundamental announcements? How can I sign up for all the webinars? Good question. Yeah, I do, and I analyze and follow these announcements. I mean, I tend not to be a news trader myself, just because it's hard enough to try to correctly forecast the news or forecast certain economic report. But in addition, you have to correctly forecast how the market will react to that. So there's so many different factors with that, and that's why I find technical types of trading analyses are helpful for that, because when you look at price weighs and factors all of the major variables, all the major news and information that is known about a certain market or asset. It's factored into the price. So you don't have to try to play guesswork. You can just see, and you can follow the trends, and you can see major psychological levels, and you can do the opposite of the dumb money. You can follow the smart money. But I do believe in being aware of the fundamentals, and I didn't go into ultra detail about that in this webinar just because there's just not enough time. But sure, yeah, in future paid courses and workshops, I intend to go into the fundamentals, and we could spend a lifetime studying this, and that's what makes it exciting as well. All right, let me see. Mary asks me, was that an ethical move on the Swiss franc? No, I really don't believe that was an ethical move on the part of the SNB, and many others feel the same way. That, come on, they should have really warned or at least hinted so that there could be a gradual adjustment in the markets so that they're not wiping out hedge funds and brokerage firms unnecessarily. They should at least have been dropping some hints, and then sure, yeah, you would have had the Swiss franc appreciate over maybe a period of a few weeks, and at least traders have time to exit their trades, or to at least position themselves. Whereas when you have such a sharp move and liquidity evaporates, it's just a recipe for instability, and that was really not ethical on the part of a major central bank like that, and irresponsible. Oh, Chesley tells me the U.S. dollar, Hong Kong dollar is a pair in FXCM. Okay, I actually stand corrected. That's okay. That's interesting. All right, thank you. So, all right, so you may want to stay away from trading the Hong Kong dollar. I don't believe most economists and traders expect there to be a unpegging of the U.S. dollar, Hong Kong dollar, but then again, these unpeggings do tend to occur when there are major currency moves. So something you have to realize is that the U.S. dollar has been appreciating significantly, and it's pegged to the Hong Kong dollar, and Hong Kong does tend to have an export-oriented economy. So if they're concerned that their currency is strengthening too much, many people have been speculating that at some point there could be an unpegging. So it may not happen tomorrow, but actually I wouldn't even there's really nothing to trade because it doesn't really move that much just because of the peg itself. But some traders who are very savvy, let's say hedge fund traders, are actually trying to position themselves for this ultimate unpegging. But for retail traders, I would say just stay away from the Hong Kong dollar versus other currencies, or I would just avoid it. Not worth it. All right. Nilesh, who's one of my longtime followers on social media, asks me, how worse can the commodities bust get? And how extreme will it get for the Australian dollar, Canadian dollar, New Zealand dollar? Well, I've been warning about the commodities bubble for 3 years, and the commodities bubble has deflated significantly over the past year or so. And in the meantime, in the shorter run, it appears that some of these commodities, including oil, are bouncing a little bit, or at least rebounding, which is not surprising. Nothing drops in a straight line. But I'm concerned about China. China is a major driver of commodities trends and commodity strength. So eventually when China has a hard landing, and because they have a bubble economy, similar to Japan in the late 80s, you could see demand for copper and other China-sensitive commodities probably will continue to weaken. So I'm not a longer-term bull on industrial or economically sensitive commodities. I think we could still see a further unwinding of this commodities super cycle that started around 2001 and ended around 2013 or so, within the last couple years. So I don't want to bet on upside, even though there could be a temporary rebound that maybe savvy traders can trade. But I wouldn't want to invest in copper or something that is so levered to China. I just don't think it's prudent. There are so many other assets out there. Why stick with a dog? Why stick with something that has such a high downside risk and little upside risk? I mean, there are many people who expect this, but who in their right mind expects a booming global economy? We have massive amounts of debt have been taken on since the financial crisis. We haven't learned a thing. Central banks are flooding the world with liquidity. Asset prices across the world are extremely overvalued. Stocks, bonds, property in many countries. Come on, this cannot end. It's common sense. I think anyone who thinks otherwise is just not paying attention to what is happening. So even though much of the commodities, or a good portion of the commodities bust is still priced in somewhat, but I don't think this is the bottom anytime soon. Especially if there's a longer term rally in the U.S. dollar or bull market. Commodities trade inversely with the U.S. dollar. So you saw that longer-term breakout that I showed. I'll show you right now. This is a longer-term dollar breakout. That's not exactly inspiring for me to buy commodities when I see that. So there are better trades out there, better investments out there, in my opinion. This is not investment advice, just saying how I see it for now. All right, let me see. Peter asks me, you mentioned that there are a few other ways to detect the smart money. Can you please mention them? Well, it really depends on the market that you're looking at. For example, on intraday, if you're an intraday stock trader, like a day trader, and the people in our cyber group, which includes Rich and Fausto, and including myself once in a while, who are trading intraday stocks, are following the smart money via level 2, NASDAQ level 2 in total view. So they're following the smart money on a very micro scale to spot micro moves. These are not micro moves in terms of profitability, but just in terms of time, and it may only be, they may hold only 10, 20, 30 seconds, but they can do quite well. So they're following the market makers and other institutions as they position themselves for ahead of important moves on intraday. So that's one way of going about it. Another way, well, I know other ways there aren't many other ways to follow the smart money itself per se, but here's how you can basically replicate what the smart money is doing, and that's by doing the opposite of the dumb money, because they typically trade in an opposite manner as the dumb money. So one way of doing it is there are countless sentiment indicators out there. I would love to do an entire class just on sentiment and contrarian trading, but sentiment indicators where you see whether they're polling investors to see their opinion on the market, or it's derived, let's say sentiment is derived from options, like let's say in the case of implied volatility is one way, the volatility index. When traders are very fearful or too fearful, you'll have the volatility index, I'll show you right now, or fear index for the U.S. markets. I'm going to show you right now just so you can visualize. One second. This is the VIX right here. Whoops. Volatility index. So this is a fear gauge for the U.S. stock market, and what happens is at major peaks, like typically around 40 on this index, that's usually a sign of a major market bottom, because traders are, or the dumb money, are too fearful. And when they're fearful, that's when you want to get greedy. That's to paraphrase a Warren Buffett quote. It's basically, so what you do is you look over here. This is a major panic in late 2011 and another one early 2010, and that would have been an indicator that, hey, you want to go the opposite way of the crowd. Let's see what the S&P 500 did. Watch. Sure enough, it marked a low or a bottom in early 2010 and also in late 2011. It will alternate back and forth. So that's one way of going about doing the opposite. Also, on the flip side, when traders become too complacent, if the volatility index is too low, then that's a sign that the stock market may eventually pull back. Traders are just too complacent. They're not worried about a pullback, and they're thinking, oh, the Fed's got our backs. They're going to keep printing money and keep rates at 0% forever. Of course, that's not true. You may want to take a defensive position on stocks. And during bubbles, you'll see a very low VIX. And I believe we've been experiencing a stock bubble for the past 2-3 years, or probably say 2 years. So the VIX is very low. It doesn't mean I won't trade it to the upside, but I also don't want to be a long-term investor in the U.S. stock market right now. Let me see. Steven asks me, well said, this ends badly. Do you read Currency Wars by Jim Rickards in his new book? I do, actually. I have read it, yes. And Jim Rickards, I know Jim Rickards. He's one of my followers, and I follow him, and I've had phone conversations with him. And we see eye to eye on many different topics. And I do agree with him about Currency Wars. And what he said has been very prescient. I believe he published his book Currency Wars back around 2011, and that was before the term became really popular, and that was before we really started to see that, and sure enough, it looks like everything he's saying is coming into fruition, which is very worrisome because he's warning about a global financial meltdown. So, and that's my concern as well. I mean, really, I hate to be like this. I hate to think this way, but when you see such massive debt, I don't have charts handy right now, but when you see such a massive accumulation of debt as we've seen since 2008 around the world in countries like Australia, Canada, emerging markets, there's no other way that could end. I mean, really, it's what's going to happen? Are unicorns going to come down from heaven and they're going to erase our debt for us? No. I mean, it's really can only end one way, Mary asks me, who is the author you mentioned? I'm going to give you guys the link. Jim Rickards. I'm going to give you the link right now on Amazon. The book is called Currency Wars. That was his book from 2-3 years ago. Yes, it was. Yeah, he worked with the CIA. He's a very interesting, eclectic background, and I've had the pleasure to have a nice phone conversation with him just a couple months ago. All right, I'm posting this right now. This is his first book, and this is his second book, The Death of Money. Good reads, and it really is relevant to Forex traders as well because he's always discussing these currency wars, so it's definitely, I think you should be aware, and I think we should all be aware of that. And also, if you want to follow me throughout the day, because I am constantly doing updates on Twitter about Forex moves and other market moves, so I'd recommend, if you can follow me on Twitter, here's my Twitter. And you can follow me, and I'll follow you back. I have over 66,000 active and engaged followers just on Twitter alone, and it's like a big family. We're all in this together, and we're all deciphering the market and deciphering what's going on in these unusual, unprecedented times. So it's like you need a support network, and that's part of the reason why I do it. It's not just as a service to warn about bubbles or publish trading analyses, but because it does help me, to have that support. And many of these people have become friends of mine, so it's really nice. I hope to have these friends and this network for the rest of my life. All right, Bob Ross, he asks, what's the minimum to fund the account? I believe it's $2,000. I'm about 90% certain that it is, but you can talk to an education advisor about that in further detail. I'm going to post that again, just so that you have access, just so you can discuss all those details. Here we go, and you can just call one of our friendly advisors and ask them whatever questions about the specific details, and they'll be able to answer. But I'm fairly certain it's $2,000. So is there a monthly fee? No, there is not, thankfully. The commissions and the spreads are very, very, very low. It's only about $5 or $6 to move $100,000 into, let's say, in a certain currency pair. The commissions are low compared to other markets, whereas if you were to buy or sell $100,000 worth of a stock, you'd be paying a pretty penny in commissions. So Forex is really low commissions. And Lori also asks, can you trade regular stocks there? At the moment, no. They're exclusively a Forex broker for now, but you can still manage to trade both. You can have one stock account, maybe TradeStation or another type of stock account, and then you can also have FXCM open. They have good charts as well that are helpful for stock traders if you want to see what the euro is doing or so on and so forth. Let me see. Mary says, I spoke to my broker about Jim Rickards' concerns, and they minimize these concerns as scare tactics, not something to be concerned about. Surprise, surprise, right? What else would you expect the broker to say? A broker's job is to generate commissions, and they want people to feel confident investing in the stock market so that they can generate these commissions and fees. So every time you hear these mainstream advisors and brokers and mutual fund managers, it doesn't matter. It could be the day before Lehman imploded back in 2008, and they would be like, "Oh, don't worry, and everything's going to be fine." And you had people like, so many of these high-profile people were trying to build confidence and reassurance, and I don't believe that they have investors' best interest in mind. But I'm not an investment advisor. I'm not a registered investment advisor, so I can't tell you what you should do with your money. I can only tell you what I would do with my money. And I'm just not confident in holding mainstream conventional financial assets for the longer run. I will trade them, but I'm not one of those people who are like, invest for the long run. I don't believe that right now. Yeah, sure, maybe after we see some of the concerns that I have and Jim Rickard's concern, once those play out, yeah, I would love to be a value buyer and value investor in stocks, but it's overvalued. It just doesn't make sense. I have no reason to invest in stocks right now. There's such a limited upside with now that they're so overvalued. So for me, I'm going to have to stay out for now and keep my money mostly in cash and stay liquid so I can trade trends. And in the longer run, I hope to buy some precious metals because I do believe in those in the longer run. I also believe in farmland property in the longer run. So I'd rather keep my powder dry for those things that do have potential upside versus stocks. I just think after this 6-year bull market that's driven by Fed money printing, I just don't see how that can end well. All right. Any other questions? Okay, that is a good question from someone here. Asking about FXCM stability after the Swiss franc move. It caused a panic, and they were bought out by Leucadia. Here's the thing. I am not concerned about FXCM now that Leucadia bought it. Leucadia is a major investment firm that is very, very well capitalized. I believe they have $20 billion. So FXCM is actually in better condition now. It's in a stronger position now than it was before this because it's now got the backing of a much larger, well-capitalized parent company. And this is Leucadia. This is the company that bought Jeffries a couple years ago when it had its own similar meltdown. So I'm not concerned about it. And you notice that FXCM didn't lose its clients' money. That if they had money in their account, they're still in the hole. They didn't lose. Sorry, not in the hole. I'm saying they're whole. They still have their money. They still have their original deposit. And also, as I said, just don't trade those pegged currencies. And I don't expect there to be a major move that would wipe out a brokerage firm like this. Just because there aren't any major pegged currencies that investors are trading large volume in. So I don't expect to see a replication of the Swiss franc unpegging type move in the near future. So that is one thing that definitely should make you and me feel more confident. What is the fee for your more advanced course? Good question. You know what? I would also call the advisors for that just because we're still a little bit in a flux here just because I just started this program a couple weeks ago and we're still trying to figure out how everything's going to work and the precise price points, everything like that. But if you can talk to an investment advisor, we'll definitely get you that answer very shortly, and especially as we flesh out the details of this program. So I don't want to say something and end up being wrong and misleading you guys unintentionally. But the nice thing is if you do have you open up this FXCM account, you will have access to those future courses, more advanced courses, webinars. I could just produce tons of courses, on so many different topics, your head would spin. So I'm looking forward to it. Phase 1 students, someone's asking if a Phase 1 student can take the Forex class that I'm teaching on Tuesday. That's Mary asks that. No, it's not too difficult at all. I think a lot of certainly a good portion of what I taught today will definitely be helpful with that. Actually, you know what? What I'm teaching on Tuesday is a Phase 2. So you said if you're a Phase 1 student, then that's the natural progression. You should be fine. You should be able to take Phase 2 with no problem. And if not, you can review some of the old recordings of the Phase 1. So the Phase 2 is, the way I'm going to be teaching it is in a very logical, intuitive manner where I'm still going to be conveying a lot of solid information, but I want it to be very understandable. And you can ask questions. So don't be concerned about that. But if you want, go review the Phase 1 again. You can access log into the homepage, log into your account, and you can go and watch the old recordings, and then you should be more than prepared for this coming class on Tuesday. All right. Any last questions? Last call. And, I'm going to be doing more of these webinars in the future, so we don't have to, if you think of other questions in the next few weeks, then you can definitely ask them, and I'll do my best to answer them. So thank you, everyone. I'm going to go eat some Greek food and gyros because it's my brother's 21st birthday, so looking forward to that. So see you guys soon, all right? Take care. Have a great weekend.